Okay, everybody, let's go over an explanation of these amendments. They're relatively straightforward, and basically they're just good faith amendments to comply with some recent laws. They're a long time coming out, and we're going to have a bunch more big changes in the coming months. But let's just go over an explanation of these and a couple of things. First off, the italicized text down underneath each choice is the default. If there isn't an X in front, then it's going to go to the default. Also, the dates are going to be left empty because they're going to be effective as of the date you sign it or the effective date of that law. Number one, employer contributions on a Roth basis. This doesn't really apply for solo plans. Basically, what it's saying is, can the employer, the business, make direct Roth contributions based upon matching of what your deferral is and everything? You already can do that with your plan, and so we're going to say yes, you can, but it really doesn't apply for your particular plan. Number two, can spouses, military spouses, enter the plan? Answer is yes. Once again, I don't think it's going to apply to most of you, but we strive to make our plans as flexible as possible for as many people as possible. So we're saying that yes, our plans do allow that particular provision. Number three, another one that doesn't really apply, but we did say yes, we're going to allow it once again for maximum flexibility. And that's just saying, hey, if somebody makes payments on their student loan, can we make matching contributions based upon those payments? So we said yes. Doesn't really apply because there's really not matching with solo 401k plans. Rather, there's just contributions that you make out of your salary deferral, and then there's profit sharing. So we're already maximizing out as much as possible with the profit sharing to begin with. Next, number four, can your plan make a emergency personal expense distribution? Once again, we want to give you maximum flexibility. We said yes. Not the most exciting thing, though. This really maxes out at $1,000, and then you've also got 3 years to pay it back. Auto portability transaction, we didn't make any selection on that because it really doesn't apply. It's just saying, can your plan accept money that you had in a prior account, in a prior 401k plan that was distributed because the balance was too low? I don't think that's going to apply to anybody here. So we just ignored that, and we chose just to do the default of saying your plan can't accept those contributions because they're really not going to apply to anybody who's got one of our plans. Number six, involuntary force out. This is directly related to the auto portability. And involuntary force out is whenever somebody only had, assets of under $5,000 in previous years inside the retirement plan. The retirement plan could kick the money out of their retirement plan and put it inside of an IRA. And so this is just increasing the limits. It used to be $5,000, now it's $7,000. If somebody quits a job and has less than $7,000 of assets, those assets can be automatically moved into an IRA. So the retirement plan doesn't have to deal with it. Doesn't apply to solo 401k plans because you guys aren't going to be kicking yourself out of the retirement plan. And that's indirectly why the auto portability doesn't apply either, because once again, it's just not going to apply to solo 401k plans. Number seven, top-heavy rules. Once again, doesn't apply to solo 401k plans, so we're just ignoring it. Next one, domestic abuse distributions. What this basically says is that within 1 year of you having a domestic abuse situation, you're allowed to take out the lesser of $10,000 or 50% of your account balance. You're also allowed to put that money back in within a 3-year time period. So we want to give maximum flexibility. So we did add that provision to the defaults on the plan here. Number nine, recontributions of distributions to terminally ill patients. If a doctor signs a certification saying that you're terminally ill, you can take money out of the plan. It's not subject to the 10% early withdrawal penalty, even if you're under 59 and a half. And also, you're allowed to have the money recontributed within the 3-year time period. Number 10, qualified disaster related loans. If you live in a federally declared disaster area, you can borrow more money out of the plan than normal. And once again, if you borrow the money out, it's a non-taxable event. How much can you borrow out? Well, instead of the maximum loan amount being the lesser of $50,000 or 50% of your account balance, that jumps to the lesser of $100,000 or 100% of your account balance. Number 11, qualified disaster recovery distributions. So long as you live in a federally declared disaster area, you're allowed to take out distributions of up to $22,000, penalty free, not having that 10% early withdrawal penalty, and you can spread out the taxes over a 3-year time period. Next, long-term part-time employees. This is a real mess. We're not making any elections. We're just going with the default on this, just using the standard language. And this basically says that if somebody is a part-time employee and they work more than 500 hours a year for you for more than 3 years, then they need to be included in the plan. Our plan documents are not set up for employees. We give way too much benefits, much flexibility. It's a disaster for an employee to be involved. If you do have somebody who meets the criteria of working more than 500 hours a year for more than 3 years, you really need to stop using our plan documents. Let us know and stop using those plan documents. And so we didn't make any election with this whatsoever because this normally doesn't apply with our plans. Next, we have pension-linked emergency savings accounts. These are really cool. I thought they were going to be a fantastic tool for people. They allow you to put in a maximum of $2,000 total. I still thought, hey, there's all sorts of ways you could do no money down transactions with these. But the challenge is they have to be invested in bank accounts. And that's kind of boring. I mean, now you're going to really get rich off of what, 0.1% interest or so. So we did check the box saying that they're allowed. They are kind of cool, but they're probably not very realistic. So, but they are allowed. Self-certification of hardship criteria. This is just basically saying, and we didn't make any other elections, we just went with the default, saying that you, the participant, is allowed to certify to the plan administrator, also you, that you're going through a hardship if you need to take a hardship distribution. Really doesn't apply to solo 401ks, but we want to make it as flexible as possible. 15, mandatory Roth catch-up provisions. Another kind of silly and stupid rule that's cumbersome, not going to apply to you guys, so we just went with the default. 16, exact same story, higher catch-up contribution limits. We just went with the default. This is just making the tax code a lot more complicated. We didn't want to make any other further elections or exclusions or anything, so it's just the default. 17, higher elective deferral limits for simple 401k plans. Doesn't apply. This isn't a simple 401k plan. Number 18, qualified long-term care distributions. Yes, we allowed that. Once again, it's probably not very realistic. It's saying you can take penalty-free distributions up to $2,500 per year. Those of you who have been in that situation know that the fees, the costs for that are going to be a lot higher than $2,500 a year. But once again, we did provide for that. Okay, those are all the optional provisions. The standard provisions are down below. You can read through those. They're pretty self-explanatory. If you guys have any further questions, please go to iraideas.com and use the book an appointment button, and more than happy to talk with you more in depth about your personal situation. Thank you so much.